Listen, I want you to picture something real, not a hypothetical, not a textbook example. A kitchen table in suburban Naperville, Illinois, on a Tuesday afternoon in April of 2026. Her name is Carol. She is 68 years old. The lasagna trays from the funeral reception are still stacked in the refrigerator. Her husband Tom, the man she married in 1986, the man who worked 32 years as a regional logistics director, the man who scraped ice off the Buick every winter morning. That man died 8 weeks ago. Heart attack in the driveway on a Sunday morning. Carol is sitting at the kitchen table, reading glasses on. A letter from her CPA she has read 3 times because she does not understand it. What the CPA is telling her, in polite professional language, is that the federal government is about to take roughly $19,300 more out of her retirement income this year than it took out last year, on less money, even though Tom is gone, even though her household income just dropped by 60%. Carol and Tom did everything right. They paid off the house. They funded the 401k. They never carried credit card debt. And now the IRS is reaching across the kitchen table, 8 weeks after the funeral, and triple rating her on the same dollar of retirement income for the rest of her life. That, my friends, is the widow's penalty. If you are watching this and you are married, and one of you has a traditional IRA, a 401k, or a defined benefit pension, the IRS has built a mathematical guillotine into the tax code that drops the moment the funeral home pulls the hearse away from your driveway. And nobody, not your broker, not your branch banker, not your generic CFP, nobody is telling you about this trap until it is too late. Before I go further, hit the like button right now. I am not asking, I am telling. The algorithm throttles senior financial truth content. Every like pushes this video to one more couple who still has time to fix it. Subscribe. Drop your age and your state in the comments. I read every one. Let me show you Carol and Tom's math line by line. In 2025, Carol and Tom filed married filing jointly. Tom's Social Security, $38,400 a year. Carol's, $19,800. Combined Social Security, $58,200. Tom drew a defined benefit pension of $42,000 a year. And listen carefully, Tom elected the single life annuity 12 years ago when he retired. We will come back to that. Tom's traditional IRA, $820,000. His RMD at age 73, roughly $30,900. Their joint brokerage at Fidelity, $310,000, throwing off $8,500 in dividends. 3 CDs totaling $145,000, $5,800 in annual interest. Total gross income, $145,400. Here is the math the IRS hopes you never look at. As MFJ in 2025, they got the $30,000 standard deduction, $3,300 age 65 plus add-on, $6,000 senior bonus from the One Big Beautiful Bill. Taxable income, roughly $106,000. The 22% MFJ bracket in 2026 runs all the way up to $206,700. Their total federal tax, approximately $11,200 on $145,000 of gross. Effective rate, 7.7%. Tom dies in March of 2026. Carol is now a single filer for the entire 2026 tax year. The IRS uses your filing status as of December 31st. There is a grace period called qualifying surviving spouse, 2 years of MFJ rates, but only if you have a dependent child living with you. Carol's kids are 39 and 37, both with their own mortgages. Carol gets 0 grace period. Her 2026 income. Tom's Social Security check is gone. Her own continues at $19,800. The pension pays 0 survivor benefit because of the single life annuity election from 12 years ago. The traditional IRA, now rolled into Carol's own account, still has $810,000. Her RMD at age 68, about $29,500. Brokerage and CDs continue, $14,300 combined. Total gross income, $63,600. She just lost 60% of household income. And here is what the IRS does to her at the same time. Single standard deduction, cut roughly in half, $15,750. Age 65 add-on for single, $2,000. Senior bonus, $6,000. Taxable income lands at $39,850. Still in the 12% bracket. Wrong. Because her provisional income is now high enough that 85% of her Social Security becomes taxable. The threshold to flip Social Security into 85% territory is $44,000 for a married couple, but only $34,000 for a single filer. That threshold has been frozen since 1993. Public Law 103-66. Carol crosses it instantly. Her Social Security adds $16,800 of taxable income that did not exist when Tom was alive. Her true taxable income climbs to $56,650, pushing her into the 22% bracket on every dollar between $48,000 and $56,000. Federal tax, roughly $11,700. On $63,600 of gross income. Effective rate, 18.4%. Last year, 7.7%. This year, 18.4%. Her effective tax rate just tripled. That is not bad luck. That is the federal tax code working exactly the way it was written. The widow's penalty has 3 distinct mechanical traps stacked on top of each other. Most CPAs only ever talk about the first one. Trap number 1, the bracket collapse. The 2026 single-filer bracket structure is mathematically half the width of the MFJ bracket at every level. The 22% MFJ bracket, $96,950 to $206,700, a $110,000 runway. The 22% single bracket, $48,475 to $103,350, a $55,000 runway. Half. The entire architecture of the federal income tax is built for couples. The second one of them dies, the survivor falls through a trap door. Trap number 2, the RMD crossfire. The required minimum distribution does not care that you are grieving. The RMD does not care that you only need $24,000 a year to pay property taxes and groceries. The RMD pulls money out of your traditional IRA at a percentage dictated by the IRS Uniform Lifetime Table. At age 73, your divisor is roughly 26.5. By age 80, you are pulling out 5% of the entire balance every year. By 85, almost 7%. The IRS forces the income out, and that forced income, sitting inside a single filer bracket, gets taxed at rates that would have been mathematically impossible under MFJ. Trap number 3, the IRMAA spike. IRMAA is a 2-year look-back. Your 2026 income determines your 2028 Medicare premiums. The IRMAA thresholds also have for a single filer. Tier 1 starts at $212,000 for MFJ, but only $106,000 for single. Carol's Magi in the year after the funeral easily crosses $106,000. Medicare Part B goes from $185 a month to roughly $260. Part D picks up a $13 surcharge, about $1,044 a year, every year, recurring, because she committed the crime of being widowed. Stop the video right now. Tell me honestly in the comments, have you and your spouse ever sat down and modeled what your taxes look like the day after one of you dies? I am betting 95% of you have never run that number. Drop your state, roughly what is in the IRA, whether the pension is single life or joint and survivor. I read every single comment. 800,000 Americans are widowed every year. The marginal tax rate jump from the bracket collapse alone, multiplied across that population, generates billions of dollars annually in incremental federal revenue. The IRS calls this revenue. You and I call it confiscation from the grieving. Send this video to a married couple you care about. One 30-minute conversation tonight between two spouses who are both still alive saves the surviving one of them roughly $75,000 over the next decade. Send the video. Save the spouse. Now, the 4 accounts you must restructure before the funeral. Account number 1. The traditional IRA, the 401k, the SEP IRA, any pre-tax retirement account. This is the single largest source of widow's penalty damage in the typical retirement portfolio. Every dollar in a traditional account is a dollar of future ordinary income. The IRS owns a percentage of that account. They have not collected yet. They are letting it grow because they get to apply a higher tax rate to a bigger pile later. The fix: aggressive, multi-year Roth conversions while both spouses are still alive and filing MFJ. Here is why it works. The 22% MFJ bracket runs all the way up to $206,700. You can convert $80,000 from traditional to Roth in a single year. Pay the tax now at 22%, and that money becomes permanently tax-free. No future RMDs, no tax on growth, no IRMAA spike from withdrawals, because Roth distributions do not count toward MAGI. No Social Security inclusion penalty. On Tom's $820,000 IRA, the lifetime tax savings from converting at MFJ rates instead of single rates, somewhere between $70,000 and $130,000. On a $1.5 million traditional balance, savings can exceed $250,000. That is the single most important pre-death move in the entire framework. Account number 2, the taxable brokerage account. This one is counterintuitive, and most CPAs get it exactly wrong. They tell couples to gift appreciated stock during their lifetime to lower the estate. That is the worst possible advice for a couple where one spouse may die first. Internal Revenue Code Section 1014, the step-up in basis. When a spouse dies and leaves appreciated assets to the survivor, the cost basis resets to fair market value as of the date of death. Every embedded capital gain, vaporized, forgiven by the federal government. But the step-up only works fully if the asset is titled correctly. In joint tenancy with rights of survivorship in a non-community property state, only the decedent's half steps up. In a community property state, California, Arizona, Idaho, Louisiana, Nevada, New Mexico, Texas, Washington, Wisconsin, the entire jointly titled property gets a double step-up, both halves. If you live in a common law state, 6 states allow non-residents to opt in via a joint revocable community property trust. Tennessee, South Dakota, Alaska, Kentucky, North Carolina, and Florida. Cost to set up: $2,000 to $4,000 with an estate planning attorney. Typical lifetime savings: $40,000 to $120,000 in avoided capital gains. Account number 3, the unprotected pension. This is the silent killer. Most pensions default to a single life annuity unless the retiring spouse affirmatively elects joint and survivor. Single life pays a higher monthly check during your life, pays 0 after death. Joint and survivor pays a smaller monthly check, but continues to the spouse for life. ERISA Section 205 requires the non-retiring spouse to sign a notarized waiver to elect single life. Most people sign that waiver without reading it. Tom Reeves signed it 12 years ago at the kitchen table. Carol signed without understanding. That single signature cost her $42,000 a year, for what could be 20 more years of life. $840,000 of survivor income, gone. The fix: pre-retirement. Elect the highest survivor percentage you can afford. Once locked into single life, cannot reverse, but you can buy a permanent life insurance policy on the pensioner's life with a death benefit sized to replace the lost pension stream. This is called pension maximization. The death benefit is income tax-free under IRC Section 101A. The replacement income is therefore tax-free. No bracket collapse exposure, no IRMAA spike, no RMD. Account number 4, the high-yield CD, the money market fund, the taxable bond portfolio, the slow leak. Interest from these accounts is fully taxable as ordinary income. While both spouses are alive, it is buried inside the wide MFJ brackets. The day one dies, the same interest stream pushes the survivor across an IRMAA tier. 3 fixes. 1. Replace CDs with in-state municipal bonds. Interest exempt from federal income tax under IRC Section 103. 2. Shift cash into a multi-year guaranteed annuity that compounds tax-deferred. 3. Fund a properly structured cash value life insurance policy. Growth tax-deferred, death benefit income tax-free under IRC Section 101A. If you execute all 4 moves before the first spouse dies, the traditional IRA was converted to Roth, survivor inherits tax-free. The brokerage was titled correctly, survivor gets full step-up. The pension was elected joint and survivor or replaced with life insurance. The CDs were converted to munis or insurance products. The widow's penalty is mathematically defanged. Carol, in our example, instead of paying $11,700 plus IRMAA, would pay roughly $2,800. Roughly $9,000 a year recovered. Across 22 years remaining life expectancy, approximately $200,000 of tax savings. Add the avoided IRMAA, the preserved pension stream, the eliminated capital gains tax, and the 4-account framework saves the average widow $400,000 to $1.3 million across her remaining lifetime. Final warning. Roth conversions take 5 to 7 years to phase. Pension elections lock the day you start drawing, irrevocable. Life insurance underwriting requires both spouses to be in reasonable health. If one of you receives a serious diagnosis, half of these tools become unavailable overnight. If you wait until the diagnosis, you have already lost. The IRS is counting on you to wait. This video is for informational purposes only and is not financial, tax, or legal advice. Restructuring retirement accounts and changing pension elections carries permanent consequences. Always consult a certified fiduciary planner and a CPA. If this saved you, scared you, or made you furious, like the video, subscribe, hit the bell. Comment with your situation. Share this with one married couple you love. Today, not tomorrow. The IRS is patient. The IRS is waiting. 800,000 widows will fall into this trap this year. You do not have to be one of them. Stay sharp, stay angry, and for the love of everything, rebalance those 4 accounts before the IRS gets the chance to.